Mr. Prime Minister, thank you very much. That was fascinating and, as I said at the outset, courageous that you undertook the strategy you did. Let me start off by asking a question on one piece of it that you did not address. You talked about your fiscal consolidation strategy and you stressed the expenditure cuts. What did you do with tax policy? What did you do on the revenue side of the budget equation?
Well, also we did quite a few things in tax policy, mainly in tax raises, unfortunately. So some of the measures included increase of VAT standard rate from 18 to 21%, abolishing a number of reduced rates, increasing our reduced rate from 5% to 10%. Increasing excises, introducing in fact dividends tax, introducing capital gains tax, which we previously did not have, introducing real estate tax on residential property, and quite a few other tax measures. So all in all, most of the 2009 amendments, second amendments done by my government, were dealing with expenditure side, whereas 2010 budget was more or less half expenditure and revenue.
Okay. Anders?
Yeah, thank you very much. I thought you provided us with a very clear overview of our questions. And I would like to add a little bit on what people do ask about. You explained very well the political economy of the situation, but you could say something more about this exchange rate issue. You have had a very clear position that Latvia should not devalue. Here in Washington, we have rather heard a broad view saying that Latvia should devalue, and it would be interesting if you would like to elaborate a bit more why you have been so firmly against devaluation and what you think that you have got out of it. What was the real alternative of devaluation? Why were you so much against it?
Okay, yes, we also had debated this devaluation option, but what we see is certainly more cons than pros. First, we are a very small and very open economy. It means that this competitiveness gain we would get through devaluation would be very short-lived, because all the imported energy prices would increase immediately, important components prices would increase immediately, and really there wouldn't be much of a long-lasting effect. Moreover, devaluation is in effect a huge redistribution of wealth from pretty much all the society to maybe a couple of biggest exporters, working exactly to the direction which is not in Eurozone or so. So while doing our fiscal adjustment, at least we could do it in a more targeted way, cutting more where we thought there were some excesses, cutting less where we thought some expenditure should be preserved, and maybe devaluation is an easy way for the government, because, well, it's one decision, and not even government's decision, it's central bank's decision. And then everybody's income is more or less eroded, real value of the income and savings. But certainly it's not an easy way for population, because that's exactly what happens. Real value of income and savings decreases rapidly. And second, through this internal devaluation, we were forced much more to focus on structural reforms, which otherwise would be again probably taken off table and saying, okay, we devaluate and feel happy about this. And now what we see in a case, for example, of Greece and Spain, those were countries which used to rely on devaluation to address economic imbalances and as a way to erode people's income, supposedly less painfully. But now, so we were considered original on this approach of not devaluating but going through the internal devaluation. But now also countries like Greece and Spain, maybe too late, came to realize that this option of devaluation is not anymore on table. So there is this option of internal devaluation, which they will have to go through. So it's, I'd say now it will be more on agenda, this internal devaluation policy, as compared with devaluation.
To put a bit of a nuance on that, the euro, of course, now itself has depreciated very sharply against the dollar and practically every other currency in the world. So do you feel you're now getting the best of both worlds in terms of your competitiveness? You've done the internal adjustments, but now also with the depreciation of the euro, presumably you get some further gain on that. But it's really a question. Does this depreciation of the euro that you are mirroring, does that give you a further positive step that you think will be helpful in achieving the objectives of your program?
Certainly it's not part of our strategy or program. In this case, most of our trade and export is going to Eurozone countries or is traded in euros. And in this sense, there is not much of a gain because we are in the same boat. It's more felt towards east with the trade to Russia, which is mainly in US dollars. There we certainly feel some competitiveness gains through depreciation, but we also feel increase of energy prices through this depreciation. So it's a bit of a mixed blessing.
Okay. Just one more question and then we open it up. You mentioned your economic relations with Russia, and of course the historical reality is there. What is now the share of your external economic activity with Russia, and do possible policy changes in Russia, like it's maybe finally joining the World Trade Organization, would those things be helpful for you as well?
As regards the share of trade with Russia, it's more or less our fourth and fifth largest trade partner in imports and exports. Of course, those places tend to vary. I wouldn't risk now to give you a figure. Maybe it's around 20%. As regards Russia's WTO accession, that's something we are supporting because certainly there are in some branches of economy arbitrary decisions by Russia to introduce some export levies or to introduce some additional tariffs for transportation, logistics sectors, and so on and so on. Which could be addressed also through Russia's WTO accession and implementation of its rules. So in this sense we are supportive of this development, but clearly that it must be made clear that Russia doesn't have to follow those rules, otherwise there's no point.
Okay, the floor is open for questions and comments. Let me ask you to identify yourself and then fire away. Ann, Morris, Arturo, and up here. First four, anyway.
Ann Krieger, lots of people have been very interested in the internal devaluation. A couple of things have been said that made it easier, or suggested that might have made it easier for Latvia. One was the suggestion, and I don't know the numbers, that many people have mortgages denominated in euros so that they knew they would be hurt by devaluation. And I'm curious as to whether that was a big factor or not. And secondly, how many people held euro-denominated assets and liabilities? Were there many bank deposits in euros, things like this, that would have made it easier for people to accept the adjustment, or was that something that was a negative?
On this sense, I would say most of the effects would have been negative because 85% of our loans were in euros, whereas in assets, much larger proportion of residence assets was stored in lats. What we were doing, basically, we were importing Eurozone's monetary policy, Eurozone's interest rates. That's why we had available those cheap credits, and that's why people were borrowing in euros. Whereas Bank of Latvia already during the boom years was quite clearly warning that time government of overheating of economy and introduced restrictive monetary policy, raising its base rates, raising reserve requirements for banks and so on. But at the end effect, it just crowded out the loans from Lats to euros. So if we look from this loans and savings perspective, it was certainly part of the argument why we did not want to go for devaluation.
Morris. Or you can go to the mic back there if you want.
Morris Goldstein from Peterson. I had a question very similar to Ann, so let me modify it a little bit. To the extent that this currency mismatch was a problem, what have you done subsequently to reduce the chances that you would have such an occurrence again?
This is a complicated topic in a sense that if you would ask, for example, Bank of Latvia, they wouldn't agree that there was a currency mismatch. And in this sense, if you have all the parameters in economy, so to say, floating and fix one, then others would actually adjust. So our problem was not so much that there was some kind of a currency mismatch. Our currency was pegged to euro already for several years. Before it was at pretty much the same exchange rate pegged to special drawing rights. What was creating imbalances was more like a real economy, rapid wage growth, rapid credit expansion. That's where we saw the real mismatch. And that's what we tried to address. And if you look at the real effective exchange rates, we also see that through this internal devaluation, we have achieved also substantial improvement of our real effective exchange rate. So you can do it through external devaluation or through internal devaluation. It's basically either way.
Arturo?
Yes, I'm Arturo Porsekansky with American University. Thank you, Mr. Prime Minister, for your presentation, and thank you in particular for your courage. My question is, we're all looking back and seeing what we could have done better to prevent precisely what happened. And in the case of the Latvian case, I was wondering if you had remained in the finance ministry, in terms of fiscal policy, controls on capital inflows, or regulation of financial intermediaries, what would you have liked to have done better?
Now we are moving to the self-praising part of the presentation. In any case, what we had been doing already while in office from 2002-2004, we at that time, when we had a solid economic growth of maybe 6% a year, we introduced also austerity measures in our budget. We reduced base expenditure of 2004 budget by 6%, and at that time really many of the politicians and also public was not understanding what for. We have an economic growth, everything is just fine, and this crazy government is introducing austerity measures. Whereas what we were trying to do was exactly what's written in, so to say, economic textbooks, to pursue anti-cyclical fiscal policy. So during the economic boom, you have to reduce budget deficit and move to the surplus. So we set a target at that time that 2004 budget deficit should not exceed 2% of GDP, and with a plan to balance a budget in 2005. And then some of the political parties were denouncing this, that they are against the populist stance of new era that budget deficit should not exceed 2% of GDP. So we were populists. And so what happened after the government changed in March 2004, first thing next government did, they basically scrapped this austerity measures and went into fiscal expansion, which was then became even more expansionary under the next government. And that's how this huge fiscal imbalance accumulated. On anti-inflation measures, again, as a party, we presented our anti-inflation plan already in June 2006, whereas government theirs only in and I would say June 2006 was probably already too late. It was after a year of debate and blaming government, we decided to create some plan to show that it can be done. And government only introduced those in spring, if I'm not mistaken, April 2007. So almost a year later, when it was effectively too late. And many of the measures were basically copy-paste from our anti-inflation plan. So in this sense, we were in our policy trying to follow basic economic rules, which the governments of that time, for some reasons, were just ignoring and saying that we are a very special case, kind of avoiding with IMF Article 4 consultations, because they would come and tell all those stupid things about need to balance the budget and so on, and all these pedal-to-metal policies. And that's unfortunately where we ended, with huge fiscal imbalances and the country worst affected by the global economic crisis in the EU.
Question up here.
I'm Giyas Naqshbandi from American University, and it happened that we did not plan it with my colleague here. Mr. Prime Minister, you mentioned something about support of export. Could you please be a little bit more specific as what form of support you are going to provide the export industries? That's number one. And how this is going to impact the unemployment rate in terms of creating job opportunity? Because as you know, in the United States, our mission is to increase our exports by 100%, and hopefully that will result in creating 2 million jobs. Thank you.
Okay, so as regards export support, one issue I already mentioned is available EU funds. We are receiving funds from the EU budget, which we can then devote to different activities. And part of those activities are support of entrepreneurship. So we targeted much more of the EU funds towards support of entrepreneurship, and especially towards export-oriented industries and towards industrial production. So that was the first support instrument, EU funds. Second support instrument, we introduced export credit guarantee scheme as of June last year. There were also for years debates that we need this export credit guarantee. So yeah, during the crisis we finally introduced this export credit guarantee scheme. Of course, it can only work towards export to what we call third countries, meaning non-EU countries. It cannot be applied to the exports within the EU because that's prohibited in the EU internal market. But in any case, given our quite substantial share of exports also to the CIS countries, to other regions in the world, it's also a helpful instrument. So those were the two main instruments we were using, and as I said, there is a feeling that there is also some positive results of this. Export first quarter this year to first quarter last year up by 10%. And certainly this also affects the employment, and the unemployment figure still remains high. But since March, we see that each month unemployment is decreasing, but still it's staying above 16%, which is certainly very high. And there is always this tendency that unemployment is lagging behind economic cycle, which means that we would only expect more substantial decrease in unemployment maybe in a year's time. It's going to be gradual, and really it's a problem which will be with us for at least next 1 to probably more years.
Barry?
Barry Wood, economics correspondent. I'd like to just focus on the dark side, if I might, because maybe it's premature to declare victory on internal devaluation. Your unemployment, as you suggest, is very high. What about the elections? Do you expect voters to reward you for these tough measures, or would the populist view likely prevail? Secondly, don't you worry that as you see the Greeks and others in the southern part of Europe go into austerity, that if everybody does that, where's the growth in Europe that you're counting on to get your own growth up? And finally, on the euro entry, isn't it possible this is a poison chalice, that over the next couple of years, before you get a declaration from Frankfurt and the community about joining, that maybe this pillar of your policy is going to be discredited among voters, and that's not going to work?
First on the upcoming elections. We have an election in 2nd of October, and of course there are different views as regards economic policies. Our party is basically advocating to continue with this international loan package, and currently it seems that we created in fact union of several parties. We could win election or be a number second in the election results. Also the government approval ratings or mine approval ratings, if you want, in fact have increased. It's really during the budget amendments 2009, the preparation of 2010 budget, it was going down quite substantially, but then when people saw that we were going through this, and we also saw while doing all those fiscal cuts, we also had put in place a social safety network. Really we see that approval ratings are in fact going up. Then interestingly, there is another union of parties created just a couple of days ago, which consists of the two parties which started this international loan package and negotiated all the key conditions. And now they are kind of back and forth. One day they are saying we should scrap this package, and others say no, we don't really mean that we should scrap it, we should renegotiate the conditions which they negotiated in the first place. Of course there is some populist movements, but not that they are able to offer any credible alternative. Okay, let's scrap the package, and then what? What then? Because devaluation is also not a popular option. If you go to the people and ask, do you want devaluation? Answer you are going to get is no. So then, and if you are saying, okay, we are not going to devaluate, but we are not going to follow this package conditions, so what then? And there is a certain degree of understanding also in society that there are not many options. That once we run into those economic imbalances, once we are pursuing pro-cyclical fiscal policy during the boom, we are bound to continue with pro-cyclical fiscal policy during the recession and probably get smarter for the next time. As regards Greece and austerities, that's something which I rose as an issue already in my introductory remarks. That really, should the Europe go for a double dip recession, it's also going to affect us quite substantially. So in this sense, I agree with you. It's too early to declare victory. We're very much dependent on which happens in a external economic environment. So what was the third question?
Yes, about the euro.
Euro. Well, as regards euro, well, it's still our plan to join euro. Moreover, it's, if you want, pre-decided because new EU member states, when they were joining the EU in the accession treaty, it's basically also foreseen that we do join Eurozone. So in this sense, it's almost technical. Once we meet Maastricht criteria, we join. We have not asked opt-outs like UK, for example, not to join Eurozone. So it's in accession treaty. We in fact have to join Eurozone. We were just unfortunate enough not to fulfill Maastricht criteria all this time. So as regards the future of Eurozone, it's certainly another important question, and our feeling is that problem of Eurozone is lack of control mechanisms within Eurozone. Because with the new countries, it's easy. You either fulfill Maastricht criteria or you are not allowed in. Whereas there are no real control mechanisms within Eurozone to ensure that countries would follow Maastricht criteria. And we know that most of the Eurozone countries don't. And that's how also Greece and Spain run into trouble. And now European Commission is coming with proposals on having some pre-screening of the national budgets before passing them to Parliament to make sure those are consistent with Maastricht criteria. There is some debate of reintroducing some sanction mechanisms, as it was the case before 2003, and so on and so on. And I think that if we address this internal control mechanism problem within Eurozone, it can continue to function as a credible and stable currency. But of course, now you have to overcome this crisis.
Could I ask you to elaborate a bit on the second of those three questions on the European economic outlook? You've mentioned it's critical for the success of your own strategy. Europe, the EU, is the biggest economic entity in the world, so it's critical for the world economy as well. Many of us here have been quite concerned about economic policy in Germany. Germany is the big surplus country within the Eurozone, it's the big creditor country, yet it is also now undertaking a program of at least modest fiscal austerity, having passed a balanced budget amendment program Chancellor Merkel announced just in the last week or so.
Well, on this, certainly this is a big debate now in Europe, how to balance both need for improving government fiscal positions, because also I suppose financial markets will not be able to finance all the countries running huge budget deficits. And on the other hand, the need for economic stimulus. And this is a fine balancing exercise. I don't see now there is a ready-made prescription. Well, Germany also, they run a budget deficit of around 5% of GDP, if I'm not mistaken, which is clearly off Maastricht criteria, and certainly they should also think how to bring their budget deficit down to the Maastricht criteria level. And, but the pace of this is crucial. I wouldn't dare to say that I have an answer to this question, which pace of adjustment is right. I think nobody does, and it's now kind of again try and look what happens approach. At the beginning of the in a crisis. We know there was lots of talks about need for fiscal stimulus to overcome the recession. Everybody was talking about this. IMF was writing working papers on this. Commission was giving recommendations on this, and so on and so on. And then it almost suddenly changed that, now we have to worry about budget deficits and cut budget deficits. And this Greek case was more like a wake-up call that there is this problem with huge budget deficit in many countries. So it's a fine balancing exercise. I don't have a ready-made answer for this.
It's a tough one. Randy and then Joe.
I'm Randy Henning here at the Institute and at American University. Mr. Prime Minister, I wanted to ask you to speak a little bit about the quality of cooperation between the European Union and the International Monetary Fund. Latvia was one of the first countries that drew financing from both entities during this recent crisis. And it took a little while for the IMF and the European Union to organize themselves for this joint operation. So I wanted to ask you whether you think this working relationship between the two levels is working well, whether there are changes you would recommend, and what lessons their cooperation in the case of Latvia holds for their cooperation in these much larger programs that have been agreed recently.
On this, I would say that after some initial period of adjustment between IMF and the European Commission, I would say that now cooperation is going fine. That's my impression from what I see from negotiations when we have IMF and Commission missions in Latvia, and really it took some initial adjustment because quite clearly it was not done before. And if you some 3 years ago would ask anyone, would EU countries apply for IMF loans, nobody would believe it. So that kind of an issue was not on the table. Now it routinely happens. It's Hungary, Latvia, Romania, Greece, which is Eurozone country, which goes even deeper. And there was lots of political debate in Europe in case of Greece, should we involve IMF or not? Because there were pros and cons. You are getting ever deeper in the EU, but eventually this decision was made to involve IMF for several reasons. For the reasons that they are credible with the financial markets. They have lots of expertise to deal with that kind of programs, more expertise than European Commission, for example, has on this. So those were two main factors why it was also made a decision to involve IMF. And there is a third factor which is less frequently cited, but it's still a factor that European Commission is EU institution, working in close cooperation with European Council, EU Council. And EU Council is where prime ministers of EU countries sit. And then you are starting to sit on two tables. And in this sense, it's better to have someone from outside with an expertise and with possibility to predetermine conditions without prime ministers of corresponding countries questioning those conditions in EU Council, for example. So also from this point of view, one outside player was important. So I would say that this relation between IMF is good, experience is being gained, but let's hope that it's a short transitional period and that in some years' time EU countries would not need IMF loans anymore. So I think that's something we should really aim for.
Let me ask a follow-up on that, Mr. Prime Minister. As you have carried out your adjustment program in Latvia, has the external conditionality pressure been helpful or harmful or not a factor? I mean, obviously the credits you got came with terms. Was that useful to you in winning domestic acceptance, or was it pretty much accepted by the public that for purely internal reasons had to go ahead and do it anyway?
Of course, from a political point of view, IMF is kind of a mixed blessing, so to say. There is lots of debate going on that we are not slaves of IMF and we should not give in, and all that kind of debates. Of course, then is other kind of debate. Oh, that's what IMF requests. Nothing that we can do. Reality is maybe somewhere in between. I think it's not easy for any country to be on IMF program, because the very fact that you are on IMF program means that something went really wrong in your economy, in your policies, economical policies, that financial markets are closed for you and you need to apply for this IMF as lender of last resort. So something is really wrong, and for IMF to stay as a lender of last resort, of course, the conditionality of this is typically very tough. So on other hand, for example, if we compare Latvia's and Lithuania's experience, Lithuania was undergoing a similar recession, a similar scale of fiscal imbalances, just without applying to IMF, mainly for the reason that they didn't have this Parex Bank case I was mentioning. Then if we, at the end of the day, look what they were doing pretty much what we were doing. Raising taxes, reducing wages, cutting public sector employment, doing structural reforms, and also they did fiscal adjustment of more than 10% of GDP. Of course, it's easier if you are doing it yourself, because then you can take better into account your sensitivities, you are more determining yourself, your path, your speed, and everything. So on this micromanagement level, it's of course much better situation. But then, on another hand, if we look at the interest rates, we are lending from IMF and Commission somewhere above 3% annual interest, whereas Lithuania was taking some loans up to 9% interest. So again, and this is also debate in Lithuania, why wouldn't we apply for IMF and how those lower interest rates, because market was charging them really high.
Yeah, Joe.
Thank you. Joe Gagnon at Peterson Institute. Mr. Prime Minister, you ended your talk on lessons for other countries from Latvia, so I want to pursue that a bit. In particular, the internal devaluation you're talking about, and suggested that as an option for other countries in the euro area. So my question for you is, how much of Latvia's good experience with that reflects its experience of strong growth in the previous decade? So if you're asking for Latvians to take wage and price cuts, significant wage and price cuts to effect an internal devaluation, they've had 10 years of very strong income growth, so they're still, even after these cuts, still feeling ahead of the game. But is that going to work as well? I mean, how important do you think that is compared to, say, a case of Portugal, for example, where there's been very slow growth of incomes in the past 10 years, and they could clearly benefit from a devaluation in terms of rebalancing fiscal and external rebalancing. But it seems to me it might be a lot harder in a case like Portugal to get that kind of internal devaluation. So I guess my question to you is, in Latvia, did you get a sense that people see that they're still better off than they were just a few years ago, and so that makes it a lot easier? Is that important to get an internal devaluation?
Well, on this, there is a relative perspective to this. If you look, for example, at Latvia and other Baltic states, of course, on one hand, you can say we were worst affected by the recession, between 15% and 18%, 15 in Estonia, 18 in Latvia, Lithuania being in between. Therefore, there was a need for this huge fiscal adjustment. But if you look relatively what we lost, we probably lost some 2 years of economic growth, because we also had a huge boom before. And if you look at other countries, Eurozone countries, their recessions are much more modest, but they also lost maybe 2 years of economic growth. And what we are discussing now, the size of the fiscal adjustment for Greece, what's on table now is around 4% of GDP for this year, which is more modest than it was in the case of Latvia. So in this sense, also their cuts, budget cuts or tax raises, will be more modest than in the case of Latvia. They will not have to do such a huge fiscal adjustment, and certainly after having rapid economic growth and rapid wage growth, it's easier to adjust it downwards by higher figures. But it's also reflected in the need of the adjustment. Whereas Greece had lots of growth, they also need to do less adjustment. Maybe Greece is a bit separate and specific case, because their fiscal imbalance was even bigger than in Latvia if you look at this fiscal cyclically corrected balance. So eventually, with respect to their economies, they may end up having a larger fiscal adjustment, but that's only because they had a larger cyclically corrected imbalance. But really, it's a bit relative to previous growth and previous and current recessions.
Let me ask you maybe one more broad question about the future of Europe. For you as an active participant in it, being head of government of an EU member country. In one sense, the European crisis has exposed the structural weakness of Europe itself, of the European integration project. It has achieved monetary union with the euro, the European Central Bank, but not real economic union. So, which way will it go coming out of the crisis? Will it now be galvanized to take further positive steps toward full economic union, perhaps moving towards some kind of greater fiscal coordination and even common fiscal operations? Or will it kind of fall back in the face of pressures from individual countries in the wake of the crisis and even weaken as a central body? We've just published a new analysis here that suggests that the method of European adjustment to the crisis will be coordinated fiscal austerity. And that's what you've described, and rightly so. Individual countries need to get their houses in order. But will that be the sole mechanism for responding to the crisis and trying to prevent future crises? Or will there be some institutional evolution toward a more comprehensive economic, including fiscal cooperation in Europe going forward? I mean, you're a member of this club. I'm sure you watch very closely and try to help determine which way it's going. What can you share with us as to the likely future evolution of the European project as it comes out of this crisis?
Well, the direction I would prefer in this, and something which is also being discussed in EU 2020 strategy context is really moving more towards deepening of internal market, reducing of administrative barriers between EU member states, and really going more towards deeper economic integration. And that's certainly the direction I would support. And in this sense, something I already mentioned, there are already European Commission proposals for how to deal with fiscal policies. There is a need for greater coordination. Will it be exactly those proposals which are now on table, with pre-screening of national budgets, with restoring or creating a new sanction mechanisms? But this internal controls within Eurozone, it's very important. It's quite clear that those are going to be there one way or another. But I wouldn't expect now major reshuffle of the way how EU functions, because after a period of some maybe 5 years of trying to amend the EU treaty, with constitutional treaty, with failed referendums in France and Netherlands, with Lisbon Treaty and 2 referendums in Ireland, nobody is willing now to reopen discussions on the new treaty. So apparently it will have to do with within existing treaty. Something also what happened when Greece bailout was, or rescue as they prefer to say it, was discussed, that there is in Lisbon Treaty so-called no bailouts clause. So lawyers were thinking hard how to circumvent this no bailouts clause to provide rescue for Greece. And then it was found that, okay, bilateral loans of the EU member states are not really prohibited and are not running against the letter of no bailouts clause. So I would expect these future developments to stick with existing treaty and more fiscal coordination and hopefully more internal market integration.
Well, Mr. Prime Minister, we thank you very, very much for sharing your thoughts on such a wide range of issues. As many people have indicated, we are deeply in admiration of what you've been able to do. We wish you the best of success in continuing to meet your challenges. We'll invite you back in another year or two, hopefully to give us a report on the full completion of the project, your success in getting the country back on a stable growth path, and your own party and yourself being reelected with overwhelming majorities. We thank you very, very much.